GM, good morning. Welcome to the Milk Road Show, the daily crypto show that tries to understand macroeconomics until we realize nobody actually does. I'm your host, Jay Hamilton. It's Tuesday, March the 11th, and this week is all about one question. Are we in a bear market or are we in a bull market? Yesterday, we had a bear case. Today, we're going to see what Felix from Blockworks has to share with us. Now, there's many different perspectives and views to answer the question of where we are in the market cycle. But one thing that I think is really important is my view and the view of Milk Road is that the most important perspective in understanding where we are in the market is based upon the macro view, not the on-chain data or the fundamentals, not the technical analysis, not the market sentiment, but macro. And that's why we brought on Felix from the Blockworks team today. He's a macro analyst. He is the director and lead host over at the podcast Forward Guidance. And really, no one understands macro as well as he does or talks to macro experts on a regular basis as much as Felix does. Now, before we jump in, if you guys want to hear Kyle's view from the Milk Road Pro team on macro, join us tomorrow live on YouTube and Twitter at 12:05 p.m. Eastern. Kyle's going to join, and we're going to talk about where he thinks we are in the cycle, whether he's a bear, whether he's a bull, and where he sees us going for the rest of this year. Now, today's episode is brought to you by Definitive, advanced trading on every chain. It's also brought to you by Coinshift, powering top crypto treasuries with their yield-bearing stablecoin CSUSDL. You're going to hear more from both of them later in the show. Without further ado, Felix, welcome to the Milk Road Show.
What's up? Great to be here.
Yeah, man, excited to have you. First time having you on the show. Hopefully, first of many. Okay, let's start with the simple question. Not a simple answer, but are we in a bull market or a bear market?
We are closer to a bear market than a bull market. It depends how you measure it, right? Just to walk back a little bit, there's always this discussion, I feel like, inherent to a bull market versus a bear market of this idea of cycles. A lot of people have different opinions on whether the idea of a 4-year cycle exists and whether it will continue to exist. Obviously, that's been pretty anchored to the halving cycle in Bitcoin and some of these traditional factors and metrics that we look at. So if you subscribe to that worldview, there's a lot of metrics that are saying on like a time-based perspective that it's in the last innings of that cycle from that perspective. Now, I personally have the complete opposite view, which is that I'm not a big believer in cycles anymore. I mean, if you just take it from the halving cycle perspective, the law of diminishing returns in terms of just like how much those halvings impact supply coming onto the market is changing exponentially. So there's a lot less of that dynamic occurring. And then you start to add on these more TradFi idiosyncratic comparisons of, we've had the Bitcoin ETFs, right? And we've had a change in the type of buyer that is more interested in smaller size, but more passive and consistent allocation versus the fast money, hot money. But you always have that layer on top of the leverage degens that are trading 100x leverage, right, on perpetual futures. And that's always going to create some interesting opportunities to play around that. So it's like this conflict of increasing like volatility dampening from these passive buyers that are just, they're only interested in getting like a 5% allocation to Bitcoin or whatever in their portfolio, sitting in a diversified basket of other things. And then you still have that like classic fast money that's, 100x leverage long and shorting, getting liquidated, and that's going to impact price too. So there's a lot we can get into the macro of how I'm thinking about that. But, we're at this point of contention where I feel like we could see a sustained, continued either chop or bleed or pullback here, and then for things to improve pretty substantially in 2026. And what's interesting is comparing that with this traditional like 4-year cycle framework is it's almost the opposite of that. So I think that's going to catch a lot of people off guard.
Okay. So your view is short-term bearish, or maybe not fully. Are you bearish, or are you still in the undecided camp?
So we can tie in some of the macro here, but I've been pretty bearish since mid-December. And the reason for mid-December is we started to see a shift. I view risk assets and risk markets, and crypto obviously falls within that through a macro lens. That's how I think about everything. So within that lens, in mid-December, the Federal Reserve, Jerome Powell, had a pretty notable shift in the narrative and the language. And during, every couple meetings, we get an update on it's called the summary of economic projections, and also called the dot plot. And through that, we can see what is their forecast for this coming year for, how many cuts or hikes or pauses that they anticipate. What's their outlook on economic growth, on the labor market, on inflation? They publish all of that every couple of meetings. And during that meeting in December, we saw a pretty notable shift towards hawkishness. So before that, obviously, we had this initial rate cutting cycle starting in September. We started with a 50 basis point cut. That came with a couple more 25 basis point cuts. And then in December, that shifted pretty drastically. So the market was expecting quite a few cuts to sustain. And Jerome Powell and the Fed came out and what shifted everything higher. They shifted their inflation forecast for 2025 significantly higher. And when you read the tea leaves, what's that telling you is that they're more concerned about inflation. This is at a time where, if you just remember, the Fed has a dual mandate. They care about inflation and the labor market doing well. So the labor market was doing fine at the time. So they're squarely focused on inflation. And within that framework, they decided, okay, we're going to jack up our inflation forecast. It's more and more evident that that was largely due to political and Trump and tariff uncertainty baked into it. And so then you have to figure out, okay, where does that sit within the context of what's actually occurring? So my personal view is that they were being too hawkish. They were being too complacent about pausing and waiting things out versus the economic realities. There's been a lot of issues with economic data basically since post-COVID. That's led to a lot of head fakes. So that's, we've seen this, like the last inflation print in February was pretty high, but there's also been some really interesting, I won't get too deep into the weeds, but there's been some factors that have been skewing that and leading to these head fakes. So because of all this complacency from the Fed sitting within, there's a lot of uncertainty, obviously, from the fiscal and the Trump side of things, you're creating this environment where the tailwinds of positive monetary policy have turned into headwinds. So that is continuing to not change. We had a speech from Jerome Powell last Friday where he reiterated the same, we're pausing, we're keeping an eye on things. They're not really worried about this recent volatility in markets. If anything, I think he almost welcomes it. Lower stock prices, lower risk asset prices is one of the few things I think that's been holding up their lack of achievement of like the 2% inflation target. So pretty much every tailwind is a headwind right now. So you're battling against that. And I see no change in that narrative in the way they talk about things. Obviously, we have the next Federal Reserve meeting coming up on the 18th, I believe, next week. So we'll see what happens there. But overall, there's a lot of headwinds and very little tailwinds. So I'm just not trying to fight that. That's how I view the market. So it's telling me to just not fight that for now.
If you're only trading on centralized exchanges, then you're not going to make it. The best traders know the alpha is on-chain. Definitive, founded by Coinbase alums, lets you trade any token on Solana, Base, or any chain all in one platform. What makes Definitive different is its advanced order types. You can execute limit, TWAP, and stop loss completely on-chain. Plus, you get the best prices as your order is routed instantly through every DEX and liquidity pool, getting you up to 19 times lower fees. Trusted by funds, whales, and the milkman himself, now you too can trade like a pro. Milk Road listeners get a tasty glass of milk with zero fees on your first $25,000 at milkroad.definitive.fi. Meet CSUSDL, the stablecoin built for institutions and DAOs. Don't just hold basic stablecoins, earn yield, all without compromising security. Backed by regulated real-world assets and secured with institutional-grade risk management by our friends at Stakehouse Financial, put your treasury cash to work, earning native yield and protocol rewards. Built by the team behind Coinshift, which is trusted to manage over $1 billion in business treasuries on-chain, including Aave, Gitcoin, and hundreds of leading institutions, CYCSUSDL is gaining traction at milkroad.com/Coinshift. Okay, so you mentioned some head fakes in some of the data, the inflation data and the jobs reports over the past few years. It feels like every time they come out 2 months later, they change, and it's like, what can you trust anymore? But you also mentioned the impact that Trump is having, and we are at a historic level of economic uncertainty right now. Last time we had this much economic uncertainty was during COVID. What is Trump's master plan in your view, and what is he trying to achieve? Because I think coming into his second term in office, a lot of us, or his first term, depending upon how you look at it, I know it's not his second term immediately following, but a lot of us believed it would follow a similar playbook to last time. It doesn't seem like it might not play out that way. So what do you think he's trying to achieve? How do you think it's going to play out?
Yeah, I definitely think that's a good way to look at it, is that this is not Trump 1.0 being repeated. He has different goals. So something that's been talked a lot about recently is this framework that in Trump 1.0, he was tweeting and looking at the stock market every day and pumping that up. And this time there's been a notable narrative shift where he's much more tuned into the 10-year bond yield. So the government bond yields and where those are at. And there's a lot of different reasons they're focused on that. But the simplest way I could put it is that, so Treasury Secretary Scott Bessent, who was nominated and confirmed last month, he mentioned in an interview that when he first met Trump, the first thing Trump asked him is, how do we get out of this mess without crashing the economy? And by mess, what he means is that our debt to GDP levels are too high. Most of the only sustained economic growth we've seen since 2022 out of COVID has been through government funded stimulus. So, state level hiring, like if you just look at the jobs reports, it's been mostly government employees and that sort of thing. So we floated through that. And what that process has led to huge fiscal deficits. So we don't need to get into the crazy math, but the simple way to think about it is that we're running a recessionary fiscal playbook during an expansion. So, typically during a recession, the fiscal deficit increases because they're providing stimulus into the economy to try and make it recover. The last couple of years, we've been doing that during a time where the economy has been doing fantastic, like real GDP growth around over 3% steadily. So, you start to wonder, why are we doing that? And that has a lot of long-term impacts. We've seen, debt levels skyrocket at the same time that we've seen the private sector actually begin to get crowded out. So this is crowding out effect that economists talk about, which is that if you have too much of a heavy hand at the public sector, it crowds out the private sector. And it's hard for the private sector to be competitive when these people can go get a job with the government, and it's always going to be less efficient. It's just a law of nature, really. So Trump wants to reverse all that. He wants to reinvigorate the private sector and bring down the public sector. He wants to do that for a few reasons. It's the most sustainable growth path, really. You can't just continuously prop up GDP growth through government expenditure. So you need to reinvigorate that private sector. There's a lot of concern about the fiscal health of the government, right? So, you hear, like, the simple way that Elon Musk says this in the news is that he's worried about the US going bankrupt. Now, the US is never going to go bankrupt. As long as they can print their own currency, there's not going to be a debt default. But
damn, it's a good headline by Elon.
It's good. It's a good, fun headline. The modern monetary theorists wouldn't agree with it, but it does get to an important point, which is that the trajectory of the fiscal deficit we're in is not sustainable. Yes. And it leads to less and less people wanting to own US government debt because of, as you get increased fiscal deficits, you get more inflation, you get more supply of debt coming on. That leads to lower bond prices. That leads to losers, suckers at the table. So yeah, they want to shift all that, and they're willing to see some pain in the short term to get to a more healthy fiscal path. There's a lot of different speculations on what the game plan is there. Obviously Trump is the big tariff guy. He's been talking a lot about tariffs as a means to basically recalibrate the trade deficit, to bring in more tax revenues. And tariffs are a tax. Like, it gets confused a lot, but it's the domestic country that is paying it, and it's being levied by the actual government. It's not the country that they're fighting against putting on that tariff, right? So there's a lot of different recalibrations, and we're all trying to figure out where does this lead us and what the timeline is. So there's been, they've been quite explicit on it. Like, Scott Bessent has just been doing these 45-minute interviews almost every day on every news outlet. And they're saying these things about, we need a detox. We need to move towards a private sector economy from this public heavy one that we've been in. And there might be some pain involved with that. Things are rolling a bit over. And I think they want to front load this pain, because the sooner they do it to when the previous administration was in, the more they can blame these issues on them. If they wait, it starts to be on their own book, and it starts to be closer to midterms. So there's a lot of trying to press it as fast as we can. And so I think a lot of this chaos and uncertainty and driving down of asset prices is intentional, because in their perspective, and ideologically, I agree with a lot of it. I definitely have some criticisms on the way they're going about it, but that's what they want to do. They want to recalibrate the economy back to this like Reaganomics, private sector led economy.
Okay. And so in order to achieve that, we have to go through a reset. We have to go through some pain in the markets. What do you think that pain looks like? Does it look like a short bear market? Does it look like a sustained long bear market? Obviously, as you said, Trump is concerned about the midterms. He is very much motivated by the market in order to show all of his voters, especially the higher wealth ones, that he is favoring them. What are the probabilities of scenarios that you think could play out over the next year?
Yeah, I think they're looking at it like a 3 to 4 month detox period. They keep saying,
okay, so pretty short.
Yeah, pretty short. It's interesting. There's an Axios article that came out this morning, and there's a lot of insider headlines, just like White House sources and, top level Republican senates. And a lot of their talk is that, we're all good with the stock market downturn right now, but if it's still like this in a month's time, we got a problem. So that was really interesting to me to hear a bit about like what timeline they're thinking about there. So I think it's like a 3 to 4 month thing. I'm still not in the camp of this turning into a recession. I see it more as being, so there's a lot of nuance. There's recession, there's a growth scare, there's a growth slowdown. And really what we're talking about here is that we've had overly elevated real GDP growth. Like 3% is elevated. 2% is the long-term normal. Anything below that starts to get into that growth scare camp. So I'm definitely all in the camp that we're going from like a 3% to a 2%. And then in that process, there's a pretty good likelihood that we could also see a scare of 1% maybe. But to get to an outright recession is still not my base, but it is getting riskier every day. They're playing with fire here. It's a bold strategy to think you can do this and then also be able to come in underneath and save it in the 11th hour. Especially, they're following a lot of like the Reagan playbook. Like this is what he did when he came in is nuke things pretty aggressively and then recalibrated the economy towards this more like supply side economy. But he was doing that when debt to GDP was at 50%. And now we're at 140% or whatever we're at now. So at least double, almost triple. When you're doing this with that much leverage, like it's starting to be playing with fire. So I don't think we're in full danger zone yet. It is going to be a viable dip, probably sooner than later. I think it's too late to turn fully bearish now. If you're locked into things, you just gotta grit your teeth. But then if you cash on the sidelines, it is more so time to start thinking about what to do next, knowing that I don't think this is going to be like a 2-year bear market.
Mm-hmm. How much lower do you think we go? Like how at what point are they like we've achieved the washout? Like we've gotten to the asset prices. And I think this is more of a equities question than a crypto question.
Yeah. So, I think we just passed about like a 10%, which is a correction in equity terms. Typically like 10% is correction, 20% is a bear market. So we're around halfway towards a bear market now. And basically, as soon as we started to pass that, we've started to see some headlines from the White House saying, we're looking at it, but we're not too worried yet. So historically speaking, anytime equities get to around down 20%, let's ignore COVID because that was unique. But if we look at like 2018, there was a pretty big equity pullback back then. We hit like down 20% in SPY. This is when Jerome Powell was also the head of the Fed. And around down 20% is when they fully pivoted and started to try to get under this and ease pretty aggressively. So I think between maybe 17 to 20% downturn, you could start to expect the cavalry to start to arrive. Now, the issue is that a lot of people get confused and think that the Fed just looks at the S&P 500 and reacts to that. They don't. They look at credit. They don't look at equity. They don't really care about equities, but people get them mixed up. So I've been kind of pounding the drum that you need to be looking at credit spreads, which is basically the probability or the likelihood of of corporate credit or corporate bonds to basically default. What is the probability of default? That is the mechanism that they really care about, because credit spreads get mechanically trickled into every part of the economy. It's not just like equity holders where, it's just like, oh, the rich people lost some money, but this is like the nuts and bolts of the economy, and it does trickle into other things. So what's interesting is that if you look at equities, we're in a correction zone now. But if you look at like high yield, you can just look at like ticker HYGH on TradingView. This is a really clean way for people to track this. And there, we're down a little bit, but we're still in a pretty good area. So you have to start thinking about, okay, either we're too far pulled back in the equity market because the credit market is saying things are fine. Mostly recessions aren't anywhere close right now. Or credit markets are lagging and about to turn down lower here. So credit spreads will widen. And that means that's when we start to get into this like panic zone of potential recession and also sustained lower prices in risk assets. So you really got to be honed in on that. That is what they care about. They're really focused on looking at those credit spreads, looking at the plumbing of the economy in markets as well, and seeing where we go. So yeah, 20% I think is a pretty big buy zone in equity. If you transfer that to like Bitcoin or something like that, we're sort of, I look at it a bit more technically, and I'm just looking at the chart, but we obviously had the breakdown of this range in the 90 to 108,000 area. And now we're sort of in no man's land and chopping right now as we try to recalibrate and understand where we're at. And not really interested in being too brave in this no man's land area, but we know that below that, between like 50,000 and 70,000 is a very big support zone. So you get anything below 70,000, and I think you start buying hand over fist there. I would be shocked to see it go much lower than that.
Okay, so we've talked a bit about growth. We've talked a bit about inflation. Let's talk about liquidity, because liquidity is, China is going to fire they're already starting to fire liquidity bazooka, and they've got to fire it. The US has said they won't do QE, but QT seems to be done. What's the state of liquidity? What are you watching, and where do you think that goes?
Yeah, liquidity is a bit of a nightmarish term, because so many people have different definitions for it and different ways they view it. Some people assume liquidity just means QE. Some people view it as like, the Fed balance sheet. We've seen it like minus RRP minus TGA. That's been like this like net liquidity function that a lot of people started to tout around. It's a dangerous game to play because it's quite nuanced. I think, like, I don't know if you've had or looked much into like Michael Howell and like,
yeah, had him on the show a few months ago. Yeah.
Nice. Yeah. So he's got the most robust framework of liquidity, because it's a lot more complicated than just looking at like those three simple things that you can just subtract in TradingView or whatever. And really what it's showing is just the inflows, outflows of bank reserves within the system. That's really actually what it's tracking. And so that US liquidity situation, or just like the bank reserves levels, it's in an okay place, but there's no real downside moves much more. So the way like the Fed thinks about this is they want bank reserves to be at about $3 trillion ish. And the way they calculate that is like bank reserves plus the reverse repo balance. The reverse repo balance has pretty much offset all the quantitative tightening of the last couple of years. That's where it's come from. So if you look at like bank reserves themselves, we've actually been like at this $3 trillion level for like a couple of years now. But the way they view it is bank reserves plus RRP, which ends up being like 5 trillion. But now with both of those netted out, we're really close to the floor of where they want to get to. This is why you're starting to see talk about ending quantitative tightening. Some other acronyms coming to light, starting to think about it. But really the simple way you can break it down now is that we're near the bottom range of where they want to get to. They don't want to go much lower. So they're looking for the exit of things like quantitative tightening. But they're also not looking for adding a ton of liquidity. And this is where it gets really messy. If you just look at the Fed balance sheet, and when it goes up, people call that QE. It's a lot more nuanced than that. I don't want to get too deep into it today, but really there's multiple variations of what's driving that balance sheet higher. the traditional version of quantitative easing has never happened with Fed funds rate above zero. It's only a thing they've ever used when it's at 0%. And it's something they've reiterated that they'll only ever use at 0%. So this idea of, oh, the Fed is always going to, well, they say they don't want to do QE, but they always do. Yeah, they always do, but only when the rates are already at zero. Like there's never been a time outside of that where they haven't. The thing that people get confused about is that there's other things that can drive the balance sheet up and down, namely different loan facilities. So we had like the BTFP loan facility that came out during the SVB crisis. And that was maybe like, it depends on how you nuanced you want to get on the nomenclature of all of this, but it's not quantitative easing in terms of a permanent purchase. It's a form of a loan facility. And so those loan facilities can always come up at any given time. We don't need to be at a rate of zero for that to happen. And in the same vein, there's a forecast. Like even if you look at like the Congressional Budget Office, like they forecast the Fed balance sheet to increase basically from here for the next 5 years. And that has more to do with the reserve level matching GDP. And basically there's ways they do that where it's pretty much liquidity neutral. So it's going to head fake a lot of people in 6 months time, I guarantee it, where they're going to see the Fed balance sheet going up and say, oh my God, they're doing QE, even though they're saying they're not. They're not doing QE. It's something to do with just the bank reserve level management. So all that to say is that the US liquidity outlook is neutral at best. I don't see any real positive opportunities for it to go meaningfully higher unless things get a lot worse, right? Like if we get a recession and they jack rates down to zero and it's still not helping, then QE could come. But like, your crypto coins are going to be down another 70%. So it's like, I wouldn't really be holding out hope for that. And then the China side you mentioned, yeah, there's a lot of monetary stimulus coming from there, but we're still seeing them be pretty headstrong on not going all out on the fiscal side of things, which is really what is needed here. China's going through what the US did in 2008 in terms of real estate deleveraging. And so during those sort of deleveragings, you can throw as much liquidity at it as you want, but unless somebody comes in and underwrites the deleveraging, i.e. the government, through fiscal stimulus, comes in and covers that underwriting, you're still going to see very, very lack from China. So we're all, most macro pundits are waiting out to see for that to change. And my theory has been that they've been waiting for a weaker Chinese yuan relative to the US. So it always gets confusing when you talk about foreign exchange because it's in pairs. So it's like one has to move to offset the other. But really, it's that the US dollar was too high for them to meaningfully stimulate. Now, obviously, the US dollar has come down quite a bit recently, which has strengthened the yuan. And so maybe now they'll be thinking about doing the fiscal. But again, to put that all simply, is that we're still waiting for meaningful liquidity from China, and US is neutral at best. And so it's there's not much there to get too excited for bulls, I would say.
Okay. So is everything summed up pretty nicely in this? I'm just going to bring up a tweet that you reshared in this image.
Yes. So yeah, this is super interesting because people keep thinking that Trump and Besant are trying to force Powell to cut rates and that they're infighting. I think Scott Besant and Powell are totally aligned. They meet for lunch every week. I don't know how many people know this, but they meet every week for lunch and they discuss things. There's a lot of coordination in this day and age between the Treasury and the Fed. For Powell's main headache has been this inability to get inflation back to 2% because this entire couple of years he's been fighting against an extremely loose and dovish fiscal impulse. So the Biden administration has been extremely loose in terms of the amount of levers they can pull. So, time and time again, while he's trying to jack rates up and tame inflation, he's fighting that on the other side. And I think that's a big reason why we've seen stocks hit all-time highs throughout this phase of rate hikes and QT.
That's why we got 2 years of this incredible equity run.
Yeah, exactly.
Really, and it doesn't make sense.
Yeah, and it's because of the fiscal strength of everything. So that's been a headache for him. It's been going completely against what him and the Fed have been trying to do. The best way to truly kill inflation is obviously a recession. I don't think either of them really want that. But I do think meaningfully lower stock prices and pulling back the fiscal impulse at the same time, those have been the two things that have been floating us. Is, we've heard this talk of like the K-shaped economy where the lower K has just been basically in a recession and struggling for the last 2 years, while the high income earners, the stock owners, the asset owners have been doing extremely well, living life. And so that has been continuing on, and the only way you stop that is through lower asset prices. So I think Powell is very happy to see stock prices lower. I think that's why, even in his speech last Friday, he seemed happy. He seemed upbeat. He was not worried about the market volatility at all. He's totally aligned on it. So that achieves a lot of his goals. And then obviously we've talked about the goals on the Best and the Trump side, right? Is that they want to get the 10-year yield lower for a variety of reasons that we discussed about. Obviously, another one that I didn't mention is just the ability to refinance what has been, the Yellen administration.
Yeah.
So Secretary Yellen and the Biden administration, their strategy in this fiscal dominance that we've seen in the last few years has been to issue treasury bills very heavily and dominantly, and to avoid at all costs adding any marginal increase in coupon duration on the longer end. So now we have this situation where our composition of debt is very, very much skewed towards bills, and that's just not like a sustainable path for a fiscally prudent economy and government to be in. It's much better to be in a realm where you have debt issued on longer term maturities. So I think the best course of action of what they want to pursue there is to be able to get the rates as low as possible to then refinance that into longer duration debt. So there's two ways to think about this. Is that obviously they have these bills, and bills means that it's anything less than 1 year maturity. So no matter what, every bill gets refinanced within a year's time. We've had 100 basis points of cuts so far, and that directly impacts those bill yields. So there is this positivity where some of those bills that were issued when the Fed funds was 100 basis points higher can now be refinanced 100 basis points lower. So that's good. But overall, like, that starts to, we're starting to see the end of that positivity in terms of the refinancing. Eventually we get to this point where it's like, okay, either we just keep rolling these and refinancing them every year. And that provides a lot of we call it roll risk in fixed income, but it's the idea that instead of just owning a 10-year bond and knowing that's the coupon you get for 10 years, you have to roll it. Maybe if it's a 3-month bond or a 3-month bill, every 3 months, and you don't know where interest rates are going to be, right? Like, that can change with the economy. So that provides a lot of risk to the economy. So no matter what, when they talk about trying to get to a healthier economy and avoiding this idea of like a bankrupt, like Elon says it, they need to be able to transfer this overweight composition of bills towards longer durations. So, they want to be able to do that at the best cost possible, at the lowest yield possible, right? Mm-hmm. So I think there's a lot of that in there where they want to be able to get the long bond yields as low as possible and then refinance that on longer durations.
And could that be achieved within 3 to 4 months?
I think so. I mean, like, even, let's see here, what are we at right now? Like, we're at 4.25 right now. And even just before this shift in tone from the Trump administration, we were almost at 5%. So that's already 75 basis points cleared off, right? Like, if we think about that in like Federal Reserve terms, that's like 3 cuts that have come into the long bond yield market. So that's great, but I think they want to meaningfully lower. And I think they're actually a little bit frustrated with the lack of progress on the long end so far. And I think that's why, it feels like anytime that you see any sort of meaningful bounce in risk assets, Trump comes in with some sort of headline about a new tariff idea, or just something chaotic to hit it, and then we just get slammed right back lower. So I think they want it meaningfully lower, and they're fighting the bond market a little bit. I don't fully know why. Maybe it's just we need that recession scare to get fully trickled into the market. Maybe the market's just waiting out for, like, we had the CPI print tomorrow. I think that's going to be a big market mover. So maybe it's after that, and if it comes in soft, we see that bond rally that they're hoping for. But yeah, I think they want it at least below 4. So we got some work to do.
Mm-hmm. Okay, let's go back to the beginning of the episode and sort of wrap everything up in a nice bow here. So your outlook on the next, let's go a little bit longer. Let's say the next, I would say 12 to 18 months. So your short term is that we still have more pain to go. We chop / probably go a little bit lower than this, maybe another 5 to 10% in equities.
Mhm.
Who knows? Bitcoin maybe gets down below 70. Take us beyond that. These next 3 to 4 months. How do you think it goes from there?
Yeah, I think you want to buy those moments hand over fist. I think it's going to psych out a lot of traditional crypto traders that view this through that cycle theory, because so we're talking about, like late 2026. That's historically a time where it's like, just
that
bear
would be
market
bear.
doldrums.
Yeah.
And I think it's going to be the opposite. And I think that's going to confuse a lot of people. I think people need to cleanse themselves of the cycle theory, because we are a macro asset class now, and more like correlations are more tied to that than anything. And I still believe that liquidity, yes, for the next 6 months is flat at best, but in 12 to 18 months time, I think it'll be meaningfully higher. I think a lot of if they continue with what Besant and Powell are aligned on here in terms of the short-term pain to really kill inflation and achieve a refinancing wave that they want to do, that's going to lead to the Fed to finally really start to cut aggressively back towards. They want to get back to probably 2 to 2.5%, and so that's going to give them the leeway to do that. So I think things will be meaningfully better, and I think that's going to head fake a lot of people that look at these traditional cycle structures.
Right.
Because I think in 15 months things will be meaningfully higher from here.
Mm-hmm. So I guess the real question that nobody knows the answer to is just, can they achieve? How long will it take them to achieve this push to lower? Right? Will it be? Can it be done in 3 to 4 months? What would the probabilities that you would give it? Would you say one probability is 3 to 4 months? Would you give that a high probability, and then would you also give a low probability that we maybe do go more recession and this extends a little bit longer? Or would you not give that a probability at all?
Yeah, I'm definitely in the camp of speed. So here's how I think about it: is if you look at every shock or crash or anything, 2020 March crash, like COVID crash, the velocity has increased every single time. We've gone from 2008 was a slow crash, and then slow recovery, took a couple of years, and then as the leverage and the hyper financialization in the economy has increased every year since, we've seen these crashes be more pronounced and quicker in terms of their velocity. So 2020 was just down and then straight up. And I think you need to continue with that framework, that things move a lot quicker now. By the time the market price is in a recession, we're probably already coming out of a recession, because when debt levels are as high as they are, they need to react so aggressively and so quickly, or else the whole house of cards falls. So I think it's quick. So again, keep an eye on that HYGH ticker. Keep an eye on where credit spreads are, because as soon as that thing falls apart, that's when they're going to be coming in, and then we're just going to V like crazy, I think. So yeah, I would say in terms of probabilities, 4 months thing, I'd assign that at 65%, and a sustained pain path, whatever the difference is there. Too early for me to do that kind of math.
You and I are both in the West Coast, so
Exactly.
it's early in the morning for us. Okay. Is there how much conviction would you say you have in your view right now? Because what I'm hearing is quite a bit of conviction from you, whereas I think a lot of the market feels incredibly uncertain, and I'm not getting a lot of conviction from all of our guests, right? Are you still in the discovery and listening and seeing what's out there, or do you have very strong conviction in your view right now?
Yeah, I have. So, you always hear this idea of strong opinions loosely held, and that's definitely where I'm at right now. So I have conviction because I am listening, like that meme you showed earlier. I am listening to what they're telling us. You got Besant, Trump, and Powell all saying the same thing. I'm just going to ride that wave, and I think they will tell us when the time has come. So I don't see why people are fighting themselves here, trying to catch and fade this and front run it, do all this knife catching, when it's very clear that they're being very clear in their messaging. And I believe that messaging will be really clear when it shifts. And every day we're getting almost confirmations from them that it has not shifted yet. So I have the conviction because I'm taking them at their word and what they're implying. but I will also be very nimble in knowing that that can change on a dime. We can have one day where stocks, go limit down 5%, and out of nowhere, Trump can just completely turn off all tariff talk, and then we just send like crazy. So I'm being very nimble, but I'm being very attentive to what they're saying, because they're making it clear for us. And yeah, so I'm writing that. So yeah, I'm strongly convicted, but I also change my view within 5 minutes if I see it.
Maybe not that fast, Felix. Come on, you're not that easy.
10 minutes. Yeah.
All right. Felix, absolute pleasure to have you on the show. Thank you so much for your time today and for breaking it all down for us. Everybody listening in, we'll link to Felix's show if you want to go check that out. Forward Guidance over at Blockworks. Great show where he dives deeper into the macro stuff. If you want to learn more about that, highly recommend. Thanks for listening to today's episode, everybody. Before I let you go, I wanted to let you know that I am going to be at Consensus 2025 in Toronto, and I would love to hang out and meet you guys there too. We've got a discount for you in the show notes. You guys can save $350 on your tickets. That's May 14th to 16th, Consensus 2025 in Toronto. Come hang out with myself, Kyle, and a bunch of the members of the Milk Road team, and let's jam out and talk everything crypto and markets. Hope to see you guys there. Thanks again for listening, everybody. Have a wicked awesome day. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.